Singapore's economy is arguably Asia's biggest ever miracle. Here's a graph of Singapore's annual gross domestic product, GDP, growth from 1960 to the latest year as published by the World Bank. You can see just how fast its economy grew every single year. Amongst its fastest growing periods were even seen in the 20th century, where technology back then was not as robust as it is today. Yet, Singapore grew stunningly, overtaking countries after countries. But understanding its GDP growth may not really reflect the economic size of Singapore today, as it is far more than just GDP. GDP is just one indicator of a nation's economic performance, and in the case of Singapore, it only scratches the surface of its incredible transformation. Beyond GDP, there are other factors to assess the size of Singapore's economy. These ranges from global trade, finance, innovation, and a long list out there may tell you just how big Singapore's economy is. But let's first start with the basics: GDP and GDP per capita. GDP, in case you're not aware of this concept, is the total monetary value of all goods and services produced within a country over a specific period. GDP per capita, on the other hand, divides the GDP by the population, offering a more precise view of how the economy benefits individual citizens. Here's a comparative table of where Singapore's economy sits today in terms of GDP. As you can see from the table, with data that we gathered from the World Bank on GDP current US dollars, Singapore's GDP isn't really that big. They are just above the economy of Norway, Venezuela, Bangladesh, the Philippines, and so on. They are far below many economies out there. That's simply because Singapore is just a tiny country with a population much less than most nations. What can really tell us how good Singapore's economy is through their GDP per capita. Now, as you can see from the graph, with data from the same source, we can see that Singapore's GDP per capita is amongst the largest globally. They are above the United States, Australia, and nearly every single country out there. They are only below Qatar in the entire Asian continent, and it might not even be truly fair to compare Qatar to Singapore, considering Qatar is an oil-rich country, whereas Singapore holds little to no natural resources, relying mostly on human capital, a strategic government, and economic openness for its robust economy. Now that we have an understanding of where they sit in terms of their GDP, let's talk about an important part of Singapore's economy: trade. Singapore is often referred to as a global trade hub, and for good reason. The Singapore Strait is one of the busiest globally, with thousands of ships passing through every single day. But of course, just because thousands of ships pass through doesn't immediately make Singapore a top exporting hub, right? Well, one of the factors that drives Singapore's trade from its borders to the entire world is a concept called the re-export model. What this means is that Singapore imports raw materials, components, or goods, processes, or refines them, and then exports them to other countries at a higher value. For example, crude oil imported into Singapore is processed in its cutting-edge refineries into refined petroleum products like gasoline and jet fuel. These refined products are then exported to global markets, making petroleum one of Singapore's top export categories, despite the country lacking domestic oil reserves. Similarly, Singapore imports electronic components, assembles or enhances them, and exports finished or semi-finished products to countries worldwide. This model adds value to imported goods, generating revenue and supporting industries such as manufacturing, logistics, and high-tech sectors. Let's take a look at Singapore's total merchandise imports, which is a concept that helps us understand the scale of goods flowing into the country before being processed, refined, or redistributed. Total merchandise imports encompass all physical goods brought into Singapore, including raw materials, machinery, electronics, and consumer goods. As you can see from this graph with data gathered from the World Bank, Singapore's total merchandise imports skyrocketed over the time period, where in the latest year, in 2023, Singapore imported over $423 billion in merchandise. But as it imports these materials, some of them get transformed and then re-exported. Here's another graph from the same source on total merchandise exports. As you can see, merchandise exports is much more than their imports, with the latest year in 2023 amounting to over $476 billion, which indicates that Singapore's merchandise trade is at a surplus, or put simply, more money is flowing in than out. Furthermore, if you actually take a closer look, their merchandise trade every single year nearly amounts to their overall GDP. If you missed out the GDP data earlier, it was over $501 billion. Yet, their merchandise trade is nearly as big as its GDP. Another concept to add here is the trade as a percentage of GDP from the World Bank. You can see that from the graph, Singapore's trade as a percentage of GDP has been around 300%, meaning that the total value of Singapore's imports and exports is 3 times its gross domestic product. And in 2023, Singapore's GDP was over $501 billion, with its trade to GDP being over 311%. Its trade would then be more than $1.5 trillion. Then, there's also the assets under management, which is a critical defining factor in understanding the size of Singapore's economy. But first, what are assets under management? Well, this refers to the total market value of investments that financial institutions manage on behalf of their clients. In the context of Singapore, assets under management just shows its strength as a global financial hub. This encompasses investments in various kinds. So, just how big are Singapore's assets under management? Well, here is a graph with data that we collected from the Monetary Authority of Singapore. Here, as you can see, is the value of total assets under management in Singapore from 2018 to 2023. These are figures in trillions, not billions, but trillions. The latest data for 2023 is over 5.4 trillion, a figure that is much larger than most nations' GDP out there. This, again, showcases that beyond Singapore's GDP, they also have factors that are so much more than what GDP can show alone. Thirdly, one of the biggest reflections to Singapore's size is their banking total assets. Here's a graph with data that we gathered from the Monetary Authority of Singapore showing the banking system assets of the country. As you can see from July of 2021 to October of 2024, Singapore's total assets had grown substantially to over $3.6 trillion. Having total assets of this much just showcases the scale and strength of Singapore's financial ecosystem. But what's the difference between assets under management and total banking assets, you ask? Well, assets under management are basically the total market value of investments managed by financial institutions on behalf of their clients. Whereas, total banking assets encompass the assets held by banks, including loans, reserves, and investments. These can come from commercial banks like DBS, OCBC, and UOB, as well as foreign banks with a presence in Singapore. Finally, let's talk about investments, both in the form of foreign direct investment and direct investment abroad. Let's start with foreign direct investments. FDI, for short, is when a company or individual from one country invests in business interests in another country, typically by establishing operations, acquiring assets, or forming partnerships. For instance, Google has been investing substantial amounts in Singapore to make it a hub to manage operations across the Asia-Pacific region. This then is registered as a FDI for Singapore. So, How much is the FDI in Singapore? Well, here's a graph with data that we collected from Singapore Statistics. As you can see, from 2016 to 2022, Singapore's FDI has grown substantially, with the latest year 2022 amounting to over $2.6 trillion. Here's a table showing where the top economies that invest in Singapore. As you can see, the largest is the US, with over $574 billion, followed by the Cayman Islands and then Japan. Then, there's also Singapore's direct investments abroad. Unlike FDI, direct investments abroad happen when Singapore-based companies and entities invest in foreign markets, either by acquiring assets, establishing operations, or forming joint ventures. Here's data from the same source. As you can see, while it's not as big as FDI, it is still substantial, with the latest year 2022 registering over $1.39 trillion. Here's a table showing the top economies where Singapore invests in. As you can see, the most is in China, followed by the Netherlands and then the United Kingdom. Quite shocking, isn't it? Considering the largest investor in Singapore is the US. Yet for 2022, the US is nowhere in Singapore's top 10 largest direct investments abroad. But anyway, do let us know what you think. Thanks for watching.